So hi everyone, I hope you all can hear. Right. So today is our sixth session. We have done the basic of all these chapters: introduction, accounting equation, double entries, ledger accounts. We did the prime entry books, bank reconciliation, control accounts, and correction of errors. Okay, just we were revising what we have studied. Okay. So I will keep the accounting equation, accounting concepts for now. It's a theory part. Today I thought of discussing accounting adjustments. This is the key. Okay, remember in accounting, the main part is accounting adjustments. Accounting adjustments. The reason is, if you take preparation of financial statement for sole proprietorship, to do this, you need to know the accounting adjustments. Then manufacturing accounts, non-profit organization, incomplete record, partnership. Then come back to accounting for limited liability companies. So for all these main chapters, you need to know the accounting adjustments, right? So everything going forward, everything will be based on this accounting adjustments. Okay, so there are few main adjustments that we will discuss: stock, debtors, accruals, and PPE. These are main two adjustments that we will discuss. Okay, so let's move on to our chapter again. Today's chapter is chapter number 6, the accounting for sole proprietorships. So here the main point is preparing financial statements for a sole proprietorship. So in sole proprietorship, we have income statement and statement of financial position and the accounting adjustments. Right. All right. So moving to this. Preparation of financial statements. When it comes to preparation of financial statements, in financial statements, there are 5 important concepts. 5 concepts. Concept means the components. Okay. Number 1, the statement of profit and loss, which is the income statement, and statement of financial position, which is called the balance sheet. Then statement of changes in equity, statement of cash flow, and finally the notes to the financial statement. So these are the 5 main components of financial statements, right? So starting with sole proprietorship, we are starting with preparing the financial statements for sole proprietorship. So sole proprietorships, we will prepare only the statement of profit and loss and the statement of financial position, only those 2. Then we have elements. So in these financial statements, there are 5 main elements: assets, equity, liabilities, income, and expenses. Right? Okay, so this is the process. Preparing financial statement. The process of preparing financial statement. So up to the trial balance, you know the process. Okay. So once we identify the transactions from the source documents, we record the transactions in the first set of books, which is called the prime entry books. So once we record in the prime entry books, using the ledger, using the double entry principle, we transfer the transaction transactions into the, yes. Oh, can you all see the screen? Sorry. I think the screen was not visible. Okay, let me go through again. Okay. I think there was a technical issue. All right. So I was explaining the financial statements. There are 5 components of financial statements: statement of profit and loss, statement of financial position, changes in equity, cash flow, and the notes. So initially, we will be preparing financial statements for sole proprietorships. And I just started. Right. Initially, we will prepare the financial statements for sole proprietorship. So when it comes to sole proprietorship, we will prepare only the first 2 components, which is statement of profit and loss and the statement of financial position. Then in these financial statements, there are 5 elements: assets, equity, liabilities, income, and expenses. Then I was explaining the process, financial statement preparation process. How do we prepare? Right? So we prepare the financial statements from the trial balance. So as you all know, in trial balance, we have income, expenses, assets, equity, liabilities. Right? By taking the income and expenses, we prepare the income statement. By taking the income and expenses, we prepare income statement. So income minus expenses is called net profit. Right? So here the income is 3,000, expense is 2,000. So there is a profit of net profit of 1,000. So what is an income statement? Income statement shows the financial performance of the business. So remember, the income statement shows the financial performance of the business. Then in the trial balance, there are 3 more items: assets, equity, and liabilities. Assets, equity, and liabilities. So by taking the assets, equity, liabilities, if you all can remember the accounting equation. What is the basic accounting equation? The basic accounting equation says the assets equals to equity plus liabilities. Assets, the total assets equals to total equity and liabilities. So we take the remaining 3 items from the trial balance. Assets total 8,000, which is equals to equity plus net profit. The net profit belongs to the owners. So we add the net profit to the equity plus liabilities. So the balance sheet or the statement of financial position get tallied for the total asset and equity liabilities. And this shows the financial position of a business. Okay. So again, I'm repeating, income statement shows the performance, financial position shows the position of the business. Okay, so when we are preparing the financial statements, there are important adjustments that we need to know. So next I will explain the accounting adjustments. Right. Okay, so here is the draft to get a rough idea about the income statement and SOFP. Right. So income statement, we have income. There are two types of income, sales. In a business, the main income is sales income. And there may be other income. So sales income means we take the net sales. How do you calculate the net sales? Sales minus return inwards. So if you prepare the income statement, on the top, we have sales minus return inwards, sales return. So we get the net sales. Then other income. Other than sales, there can be interest income, rent income, dividend income, profit on disposal, discounts received, different types of income. Expenses. The main expense of a business is the cost of sales, the inventory, the stock. Okay, so we need to calculate the cost of the sales. So how do you get the cost of sales? Opening stock plus purchases minus closing stock. Opening stock, and we add the purchases, then you have the total stock available. And if you deduct the closing stock, you know how much stock is sold, cost of sales. Then all the other expenses we categorized into four types. Administration, selling and distribution, finance expense, and other expenses. Right. So remember, when calculating the purchases, if you have purchase the carriage inwards, we will add, and if there is return outward, we need to deduct. Any taxes, duties, anything related to purchases, we will add to the purchase cost. Okay, so this is just a overall picture, income statement. And the balance sheet, statement of financial position, you have assets and liabilities. So assets divided non-current assets and current assets, liabilities, non-current assets, non-current liabilities, and current liabilities. Then the equity, we calculate the closing equity. How do you calculate the closing equity? Opening capital plus net profit minus drawings. So this is how we calculate, we show the financial position, right? We show the five elements in the financial statements. Okay, now let's move on to the accounting adjustments. So these are the main adjustments that we are going to discuss today. Number one, inventory adjustment. So if you take any question, right, from O level to A level to, you check AAT, Chartered, CIMA, ONCCA, or any other qualifications, in the financial statement, preparation of financial statement questions, the first adjustment will be inventories. First adjustment is inventories. So under inventories, mainly you will have to do the closing inventory adjustment, closing stock adjustment. So under that, there are two concepts like cost and NRV. NRV means the net realizable value. Net realizable value. So I will explain when I explain the adjustment, closing stock. Then there can be stock damages, losses, and any other insurance claim. Stock damages, losses, insurance claim. Then stock drawings. Stock sold on sale or return basis. Stock sold on sale or return basis. There is a basis. Number two, trade receivables. In that, we have bad debt and provision for doubtful debt. Bad debt and provision for doubtful debt. Number three, accruals. That means payables, prepayments, receivables, and received in advance under accruals. The number four, property, plant, and equipment. The main adjustment is depreciation. Then we have disposal. Either we sell or exchange. Like we have an old vehicle, we give the old vehicle and buy a new vehicle. Exchange. Or an accident or damage, loss. So from the disposal, we will make a profit or a loss. So we need to identify that. Then finally, we have revaluation, revaluing the property, plant, and equipment. So these are the main accounting adjustments related to sole proprietorship. Okay. So let me start with inventories. Let me start with inventories. Okay. Right. Okay, number one, inventories. Under inventories, first I'm going to explain the closing inventory. Number one, closing inventory. So what is the closing inventory? So in all the businesses, they have to calculate the closing inventory at the end of the financial year. That is 31st March to the 31st March. For some businesses, 31st December. So according to the standard LKS2, standard related to inventory is LKS2. It says that the closing inventory should be valued at the lower of cost and net realizable value. We need to value the closing inventory at the lowest value of cost and net realizable value. So what do you mean by net realizable value? This is the equation for net realizable value. Net realizable value equals expected selling price minus expected selling expense. Let me take an example. Now let's say there is a shop. They buy milk packets. They buy milk packets, 100 milk packets at 50 rupees each. This is the cost. This is the cost. And they are planning to sell this. They buy at 50 rupees and they are planning to sell at 75 rupees. This is the selling price. They buy at 50 rupees and selling at 75 rupees. How much is the profit from one milk packet?
25.
25. Great. So now you know that milk packets, they have expiry date, right? Let's say after 4 days, there is expiry date. Okay. So let's say the expiry date is today. Today, all the milk packets will expire. You bought 100 milk packets, it's not sold. So you have all the 100 milk packets, right? Today it's expired, expiry date. Can you sell everything today? If you are selling at this price, sudden sale, can you sell everything at once?
Can't.
With the market price, you can't. So what do? You will reduce the price. Sometimes you couldn't sell this because of the damage. Sometimes it's damaged, or sometimes the expiry date is closer. So due to some reason, you can't sell this at the selling price, at the market price. You can't sell this at the market price. So if you don't sell this, your entire loss is 5,000 if you don't sell it. So therefore, somehow you need to get rid of these milk packets and reduce your loss. Therefore, what you do, go to the market and you sell this at 30 rupees. You might have seen this in supermarkets, right? Even in Cargills or Kills, when at the last minute, if you go, they will sell their vegetables, fruit at a low price, even less than the cost, 50% off, 75% off, right? The reason is they need to reduce their loss and they will sell lower than the cost. This is the selling price now. This is the cost. And this is called NRV, net realizable value. If you have any selling expenses, that should be deducted from this. So you will get the net realizable value. So your NRV, selling price, is less than the cost. Right? Normal situation, selling price is high, but abnormal situation, the selling price is less. So that is why I've taken here normal situation, abnormal situation. In normal situation, your cost is 100, your selling price. Just remember NRV means selling price. Okay. NRV 150. Then your double entry for the inventory is inventory account debit. Right. I'm explaining the double entry adjustment. Inventory account debit. Cost of sales credit. Inventory account debit. Cost of sales credit. Inventory account means, where do you show inventory account? Where do you have inventory account? It's in the balance sheet. Statement of financial position. Under current asset. So one entry of the closing stock, goes to the statement of financial position. Under current asset, the first item is inventory. The second entry goes to the cost of sales, which is in the income statement. Under cost of sales minus closing stock. We deduct the closing stock. Okay, so that is the normal situation. One entry goes to the SOFP, the other entry goes to the cost of sales. Okay, then the second scenario, NRV is less. What is mean by less? You buy at 100, but you are selling at, you are planning to sell at 80. So there is a loss of 20, expected loss of 20. Because of damage or expiry, you are planning to sell at a price lower than the cost. Right? You are planning. This is still, you didn't sell it, but in future you will sell at a lower price. So this will make a future loss. Any future loss should be recognized based on the prudence concept. Based on the prudence concept, we need to recognize the future losses. Then the double entry will be, now there will be 3 entries in your financial statements. Inventory account debit, this is the amount goes to SOFP. Current asset 80. Right, current asset 80. Then income statement under other expenses. Stock written off 20. This is the loss. And cost of sales, that is in your income statement, income statement, you have to deduct the total cost 100. Okay, very simple. Inventories, there are two situations. Right? In first situation, if the selling price is high, nothing to worry, just take only the cost. You don't worry about the NRV. You take only the cost and record the double entry. But if the NRV is less, then you have to take only 80 to the current asset. 20 loss, 100 to the cost of sales. Any doubts? There's a doubt. Can we say stock written off as stop loss on NRV? Yes. Yeah, that is fine. No problem. Okay. Next, we will move to trade receivable. There is a question. So why inventory comes in debit side? Inventory is an asset. Asset increase is debit. Inventory is an asset. Asset debit. You can ask any question. Any doubts, I will clear them. Right. Now, the second part, second item, trade receivables. Right. Trade receivables. Number 2. I will share all these notes. Trade receivables. Under this, there are 2 subtopics. Right. One is bad debt. Other one is provision for doubtful debt. Bad debt and provision for doubtful debts. Bad debt means the amount you cannot recover from the debtors. Unrecoverable debt. Either the debtor is bankrupted or dead. Therefore, you can't recover the money from the debtor. You can't get it. So this is a loss. This is an expense. So expense account debit, bad debt account debit, and you have to deduct from the debtors. Debtors account credit. Bad debt account debit, debtors account credit. Right? What is the double entry for bad debt? Bad debt expense account debit, debtors account credit. Debtors will reduce. Bad debt is not an asset. Bad debt is expense. Expense debit. Asset and expenses debit. Number 2 is provision for doubtful debt. This is the estimated amount of bad debt. We are estimating in future these debtors could be bad debt. Right? That means you have a doubt on receiving cash from the debtors. Because we know that when we do a sale, end of the year, we can't make 100% sure that everybody will pay you. Right? So there is a doubt on receiving money. So you make a provision. You estimate the bad debt. Okay, this is an estimation. That is why we call it provision. Estimate. right? So there are two types of provisions. There are two types of provision. One is specific provision. Other one is general provision. Specific provision and general provision. Specific provision means a provision made for a specific person that you know Mr. Pereira will not pay. So you, let's say from Mr. Pereira, you have a data balance of 100,000. So if he is not paying, you have to make that entire 100,000 as a provision for doubtful debt. When you have a doubt, that is called specific provision. You have a specific amount. The other type is general provision. General. That means you don't know the people, you don't know the exact amounts. So end of the year, end of the financial year, you make a percentage, 10%, 5% from the total debtors. You make a general provision. Okay, right. So let's do some questions to understand this. Example 1. I will explain all this again. Okay? You will understand when I do the example. Okay. So this is the question. Example 1. Without opening provision. Following details given for Amal traders. We have a trial balance and additional information. Following details are given for Amal traders. Trade receivables 100,000, bad debts 20,000, additional information, bad debts written off 10,000, and from the remaining trade receivables, 10% should be provided as doubtful debt. This is a general provision. Okay, what I want is the ledger accounts and the draft or highlights of income statement and statement of financial position. Can you all do this? No need to write the question. I'll share the question in the group. Income statement means, yes, profit and loss. Okay. There's a question. What is the bad debt written off? Bad debt written off means the bad debt. But I have explained. I will do this in the ledger first. So let's do the ledger account. Let's do the ledger account. Right. Another very important concept. The important thing. Anything in the trial balance. Anything in the trial balance, we record only one single entry. Anything in the trial balance, you have to enter only in one place, single entry. And in the additional information, you have to record in two places, double entries, because when preparing the trial balance, already the double entry is passed. When preparing the trial balance, already the double entry is passed. So there we have to take only the balance. But when they give the additional information, you have to make the double entries. Okay, so again, I'm repeating. Trial balance information, only once you have to record. Additional information, you have to record in two places. Okay, right. Now let me show the ledger. Trade receivables. Opening balance. So that is an asset. Therefore, debit 100,000. Debit 100,000. Trade receivables, debit 100,000. Okay. So here we draw only assets, liabilities, equity accounts only in the ledger. Bad debt 20,000. So that is a distribution expense. Okay, so we record only once these two. Now, number one, bad debts written off 10,000. And from the remaining trade receivables, 10% should be provided as doubtful debts. So first 10,000 we have to write off as bad debt. So what is the double entry? Writing off a bad debt. I'll give the journal entry. Right here. Journal entries. Double entry for bad debt. Writing off bad debt is bad debt account debit, trade receivable account credit. Bad debt account debit, debtors account credit. Yes. So this is our trade receivable account. This is credit 10,000. Bad debt. And there is a bad debt account already with a balance of 20. So this will increase by another 10,000. Therefore, total bad debt is 10,000. Double entry is this. Bad debt account debit, debtors account credit. So whichever in the trial balance, whichever in the additional information, you have to record in two places. Bad debt account credit, trade receivable account credit, and bad debt account debit. Okay, then the next 10% should be provided as doubtful debt. Now the second adjustment, first one is bad debt account debit. Now I didn't prepare a separate bad debt account. So if you prepare the bad debt account, already there is an opening balance of 20 and another 10 will be debited. So total 30. That's total 30 is here. Okay. Follow this method because in future, in when we do the complex adjustment, I won't prepare this ledgers. I will explain only through this. Okay, so that is why I'm giving the full idea about the ledger account and the income statement as well. Later, we don't use the ledger. We use only the income statement. Okay. Right. Now, what is the net debtor? Remaining trade receivable. From the remaining trade receivables, we need to make 10% provision. Now, let's calculate provision for doubtful debts. What is the remaining debtor balance? Balance carried down. Balance brought forward. Remaining debtor balance is 90,000. Balance brought forward 90,000. Okay. Then how much is doubtful debt? How much is the doubtful debt? Can you tell me? Yes. Yeah, it's 9,000. Doubtful debt is provision for doubtful debt is 10% from 90,000. From this 90,000, 10%. Okay. So what is the double entry for the doubtful debt? What is the double entry for doubtful debt? It's a provision. There is the provision. Doubtful debt expense account debit. It is treated as an expense. It is treated as an expense. So expense account debit. Expense means distribution. Doubtful debt. We call this is under provision. Expense account debit. 9,000. And provision for doubtful debt account credit. There is no opening balance. So leave opening balance. And there is doubtful debt of 9,000. So double entry is this. Okay. Then we take the closing balance. $10,000. Closing balance is 9,000. There is no opening balance. Provision for doubtful debt, is it a liability account? No, it's not a liability account. It's a asset deduction account, like the accumulated depreciation. From the total asset, you deduct. So likewise, from the debtors, you deduct. It's not a liability account. Then you take these two balances. Debtors and doubtful debt. Yeah. Trade receivables. 90,000. Trade receivables 90,000. Doubtful debt 9,000. Net amount is 81,000. It's a bad debt amount. Provision. Yeah, you can write provision for doubtful debt. So how doubtful debt is under provision? Under provision means there is no opening balance. Entire amount is under. That is why example 1 is without opening provision, and this is under provision. If you have any doubtful debt amount for the year, it increases. So we call it under provision. Is it clear? You can copy this. Sample 1. So why we don't put 100,000 as trade receivable? We don't put 100,000 as trade receivable because there is a bad debt, 10,000. Normally what we do is here from the trade receivable, if you are not preparing the ledger account, we deduct and show. We can deduct and show. Trade receivables was 100,000 and 1,000 was deducted. 10,000. Double entry is 10,000, 10,000. And doubtful debt, double entry is 9,000, 9,000. Okay. Is it clear? Did you all understand the ledger account part and the income statement SOFP? Okay, now let's do the second one. Example 2. Can you all do this example? I'm not going to prepare the ledger account. I will prepare only the income statement and SOFP. Just take few minutes and tell me how much, what is the final balance, what goes to the income statement and what goes to the SOFP. Tell me the answer. With opening provision, under provision. There is an opening provision balance. Can you all try this? So let me explain. Opening balance is done. Bad debt. Yeah. There's 20,000 open. So these are the opening balances. Then additional information, bad debt written of 10,000. Double entry, the same double entry which I gave earlier. Bad debt account debit. So here you have to add 1,000 and bad debt 10,000. Double entry. Then we need to calculate the provision for doubtful debt. So as earlier, calculate closing balance 100,000. Remaining debtor balance is 90,000. Remaining debtor balance is 90,000. Then the provision for doubtful debt will be 9,000. Provision for doubtful debt will be 9,000. 10% from the remaining trade receivables. 10% from the remaining trade receivable is 9,000. Now, in this example, there is an opening balance. That means last year they have provided 5,000 as a provision for doubtful debt. Last year they have provided 5,000 as the provision for doubtful debt. This year it should be 9,000. So there is a under provision. We have provided less. So this total should be 9,000. To make this 9,000, there is another 4,000 you have to add. You have to increase the provision by 4,000 doubtful debt. And for the income statement, only 4,000 will come. It's double entry, 4,000 debit, 4,000. That's all. So closing balance. Current assets, 90,000. Trade receivables, 90,000. Provision is 9,000, 81,000. Okay, let me explain the under provision part again. Now, net debtor balance is 90,000. From this 10% means 9,000. Okay, your current year doubtful debt should be 9,000. Already there is 5,000 in the provision account. Here we have put opening balance 5,000. Already there is a 5,000 provision in the doubtful debt account. To make this 9,000, to make this 5,000 as 9,000, you have to increase the provision by 4,000. Increase the provision by 4,000. Then it becomes total 9,000. That's why we increase. Okay. So you understood that how did we calculate the under provision? 9,000 minus opening provision. Opening provision is 5,000. So difference is 4,000. Okay. See the entire process and all the information from the trial balance we have taken only once. Okay. Double entries we have taken 2 entries. Okay. Right. Bad debt double entry is done. Provision is 4,000, 4,000. Yes, we have 5,000 from 5,000. Okay. This adjustment is compulsory. Every year there is one question definitely from the doubtful debt and bad debt. Now we are moving to example 3 with opening provision and let's do over provision. Let's do over provision. Example 3. Okay, can you do this? Following details given for Chamal Traders opening, opening, opening bad debts. Bad debts 10,000. Trade receivables, doubtful debt 10%. I'll give 5 minutes. You can do. Okay, so let's start. Trade receivables opening balance 100,000. Provision for doubtful debt opening balance 30,000. Bad debts opening balance 20,000. Right. Right. So first adjustment is bad debts 10,000. Same as before. Bad debts 10,000. Then the total bad debt will increase by 10,000. And it becomes 30,000. Double entry for bad debt. Debtors account credit. Bad debt account debit. Then from the remaining trade receivables, provision is 10%. Then we will calculate the remaining trade receivables. It's 90,000. Then provision is 9,000. Same as the previous question. Now here, your opening balance is 13. Opening balance is 30. But the balance should be 9,000. So this is called over provision. We have provided more. Previous year provided 13,000, but this year it should be 9,000. Okay, so how much is over provided? The difference in these two. Provided 4,000 more. Provided means provision. Provision. Expensed. We have made an expense. Provision means we have made an expense of 13,000 last year, but the amount should be 9,000. So previous year expense should be reduced. Therefore, $4,000 should be deducted from the provision for doubtful debt account. Here you have to debit. Okay, let me give the double entry. Now, you know the bad debt double entry, you know that debit and credit. This is 10,000. Bad debt, you know the double entry. Okay, Then the doubtful debt double entry is provision account debit. Okay. Here you have to deduct. How much? 4,000. Provision account debit. And income statement. Now over provision was added. Under provision was added. Expense increased. Since this is an over provision, the expense we have to deduct. Doubtful debt over provision, we can minus. So here is the double entry. 4,000 debit, 4,000 credit. So this is what you need to understand. $4,000. Doubtful. Okay. So this is the double entry. So remaining assets will be remaining balance $9,000. Current assets, trade receivables 90, doubtful debt 9,000, and net is 81,000. So understand okay. So you can increase if it is under provision, and you can deduct if it is a over provision. Right. Is it clear? Because next time going specific provision and general provision. Specific and general provision. So on the current assets, do we have to take only doubtful debt 9,000? Yes, in the current assets, you have to take 9,000 from the remaining trade receivables. The 10% only you have to take. Yes, that's correct. Okay. Now let's move to the next question. Specific and general provision. Right. Okay. So this is example 4 with specific and general provision. Following details given for Dunil traders: opening balance, bad debts, specific 20 made for Mr. Ajit, and from the remaining trade receivables, 10% general provision is made as doubtful debts. Okay, I'll give 5 minutes for you all to try this question. Prepare the relevant ledger accounts and the financial statements. Ask me questions if you all have. There's a question that the trial balance provision is for the general. Now in trial balance, you don't have general specific. Both together we record as in the one account. General provision, specific provision, both we take under provision for doubtful debt account. Only for the calculation you separate it, general and specific. Okay. So in trial balance, we will maintain only one account for provision for doubtful debts. It includes general, specific, both. Let's give it a try. Right. So opening balance. So let's take the opening balances. 100,000, 2,000, 20,000. So same way, we take 100,000 debtors. Provision is 2,000. Bad debts. Okay, so that's the opening balance. Then first, additional information, bad debt. Additional bad debt, 10,000. So we increase the bad debt by 10,000. Total bad debts becomes 30,000. Total bad debts 30,000. So that's the double entry for bad debt. Okay. So closing balance, trade receivables is 90,000. Okay. So I think up to this point, it's the same thing. Now, calculating the doubtful debts. So let's calculate the doubtful debts. Right. Now there is a data balance of 9,000. Can you all tell me how much did you all get the provision for doubtful debt? This amount. What was this amount? This amount. What is this amount? What is this amount? I got one answer, 29,000. 29,000 is wrong. 83,000 wrong. I want the provision for doubtful debt. 14,000 wrong. 20. Only one answer I got. Yes, I got one correct answer. How about others? 6,000 wrong, 7,000 wrong. Only one correct. Okay. Right. Now there is total data balance of 90,000. Out of this 90,000, we divide into two. Specific provision is 20,000. Out of this 20,000 worth of data, specific. So he is completely, we need to make a provision. And the remaining data will be 70,000. Remaining data balance is 70,000. Okay. So from this 20,000, entire complete amount will be considered as doubtful debt. From this 20,000, specific means Specific means entire person, entire 20,000 will be considered as doubtful debt. Okay, 20,000 made for Mr. Ajit. This specific means Mr. Ajit, right? So his full amount is doubtful. Mr. Ajit, full amount is doubtful debt. Out of remaining, we have to make 10% general provision. So if you make 10% from this, 7,000. So total is 27,000. Total doubtful debt is 27,000. Okay, so the answer is 27,000. So opening balance is 2,000. To make this 27,000, you have to increase this 25,000. We need to increase this by 25,000. Okay. So net amount is 90 minus 27. And for the income statement, we have to take doubtful debt 25,000. That's the double entry. Doubtful debt account debit, provision account. Okay, so there is a question. Doubtful debt and provision for doubtful debt. Doubtful debt means the amount which we charge to the income statement. Provision means that is the amount that we deduct from the trade receivable and we show it. It's a we show it in the statement of financial position as a deduction from the trade receivables. That is the total amount. Okay, so every year what we do is we make expense account debit and credit that full amount to the provision for doubtful debt account. Okay, without crediting the debtors account or trade receivables account, we credit to a separate account. That account is provision for doubtful debt. So every year it will increase and decrease. Sometimes we create more provision, sometimes we create less provision. So that additional amount only we transfer to the income statement. If we are providing more, we credit to the provision for doubtful debt account and debit the income statement. There's a question, is it wrong if I deduct the specific provision from debtor balance? Yes, it is wrong. Specific provision is not the bad debt. If you directly deduct from the debtors account, it will be treated as a bad debt. This is not a bad debt. This is not a bad debt. This is a doubtful debt for a specific person. Now the next part is sometimes they will tell you a specific provision becomes bad debt. A specific provision becomes bad debt. Then what is the double entry? I give these double entries. journal entries. Okay, now next point is I just give the double entry for that. If a specific provision becomes bad debt, then you don't debit the income statement. We have to debit the provision for doubtful debt account. Yeah, that 25,000 is here, no? So you have to debit here. It won't go to the income statement. Just note this double entry. Specific provision become bad debt means doubtful debt account debit, debtors account or trade receivables account credit. Yeah, there is a question and past papers. Yeah, related to this, I will do past papers. Don't worry. This is important because in MCQ papers, they might ask you short questions like this. There are some past papers related to this. Today we are learning the basic, right? What is the basic double entry for closing stock? What is NRV? What is the cost? How do you record it? Then the debtors, what is bad debt? What is doubtful debt? What is specific provision? What is general provision? Okay. Then after that only we will go to the questions. Right. Now the third adjustment. Let's move to the third adjustment. There's a question, sir, is provision is an expense. Provision is not an expense. Doubtful debt is the expense. Yeah, this is the expense. Provision is a reduction from the asset. From the asset, you deduct and show. That is provision. So provision for doubtful debt, you deduct from debtors. Provision for depreciation, you deduct from the cost of the PPE. Okay, it is not a provision is not an expense. Expense is the doubtful debt. Provision is it's a deduction from the total asset. There is another question. So MCQ, do we need to have do the working in a separate paper? Yeah, MCQ you can use a separate paper. Even in the paper that you get, you can do it. You need to only cross the answers in the answers sheet. Okay, you can do the workings in a separate paper. Right. Now let's move to accruals. Accruals. Okay, so here is accruals. So we did inventories and trade receivables. Now I'll explain accruals. So when it comes to accruals, we have expenses and income. Expenses and income. Then there is expenses payable and prepaid expenses. Expenses payable is a liability, prepaid expenses is an asset. Then there is income. Income receivable is an asset. Income received in advance is a liability. Income receivable and income received in advance. Okay, so I will explain this using some examples. So let's start with expenses. Okay. Okay, so we will start from the expenses. Expenses, as I said, I have taken two types: expenses payable and prepaid expenses. There is a question, uh, expense payable, a liability, or what? Okay, so using the example, I will explain that. Okay, then you will understand. Expenses payable. Let's say there is you are getting the electricity bill. The electricity bill is 10,000 and you pay cash 6,000. Cash paid 6,000. You are getting the electricity bill 10,000 and paying only 6,000 for the electricity. Then what about the remaining amount? Is it a liability or an asset? Second answer. Electricity payable. It's a liability, right? So you can say liability. It's a liability. Okay. Now in accounts, in ledger accounts, what happens is, there are two transactions. One is electricity paid, other one is electricity payable. That's why I put 1 and 2. Then first transaction. We need cash account, electricity expense account, and electricity payable account. These are the three ledger accounts that we need. What is the double entry for electricity paid? What is the double entry for electricity paid? When you pay electricity. Cash account credit. Yes. Cash account credit. Electricity expense account debit. Cash account credit. Electricity expense account debit. It's a double entry. Okay. So that's a double entry for electricity payment. Know that. Okay, we did in the prime entry books the cash receipt and payment. Now the second double entry is payable. Payable. What is the double entry for electricity payable? Electricity payable double entry. Tell me that. Cash account, it won't come cash because still we didn't pay that. Payable is a liability. Liability account. Very good. So double entry for payable is expense account debit, payable account credit. Payable is a liability. Expense increase. Now in expense account, you have only 6,000. This should be 10,000. So double entry for this is payable, electricity account debit, and electricity payable account credit. That's the double entry. Now you can see total expense for the month, for the year or month is 10,000. Total expense is 10,000. And in your balance sheet, there is 4,000 payable. Okay. So if you draw the income statement and SOFP, first you balance this. Expense account difference will be transferred to income statement. Payable, you have to take the closing balance. Okay. So income statement under administration, electricity expense. This is income statement. 10,000 will go. This is income statement. And closing balance of the payable, current liability. What you need is the last final thing. How much goes to income statement, how much goes to SOFP. Okay. I'm explaining the concept. How does it work in the ledger accounts? After that, when you know this concept, you can do any adjustment. Payable. Next, prepayment. Expenses paid in advance. Prepaid expense. Prepaid expense. Now I am taking the same example. Electricity bill is 10,000. Now here, you are paying more. 13,000 paid. Then if you pay more, it is called prepayment. Prepaid electricity. Prepaid electricity. So same way, you need a cash account, expense account. Now you need prepaid electricity account. Prepaid account. Then the double entries. Again, electricity cash account credit 13,000. Electricity expense account debit 13,000. Now the double entry for prepayment. What is the double entry for prepayment? Now you have paid more. This amount should be 10,000. You have excess 3,000. Therefore, electricity expense account opposite of this. expense account credit, prepaid account debit. You credit 3,000. Prepaid debit 3,000. Income statement. Then expense is 10,000. Prepaid is 3,000. So what you need is the amount goes to income statement, the amount goes to SOFP. Right. Now let's move to income. So same way, there are two types: income receivable and income received in advance. Income receivable and income received in advance. So let me explain. Income receivable. Assume that you have a building, you are giving the building on rent. So your rent income for the month is 10,000. Rent income for the month is 10,000. And first scenario, you are getting your income cash received 8,000. So 2,000 is receivable. 2,000 is receivable. So this is an asset. This is a current asset. Okay. Right. We need a cash account, rent income account, rent receivable account. We need 3 ledger accounts. So first, double entry. Since this is a receipt, cash account debit and rent income account credit. This first entry, cash account debit, rent income account credit. Then the double entry for receivable is an asset. Okay, so receivable account debit, rent income account credit, since it is an asset. This is rent receivable debit, income account credit. That's it. So for the income statement, we have to take the income for the month, which is 10,000. This total rent income 10,000 and SOFP. We have to take receivable 2,000. This is what you need. How much goes to the income statement and how much goes to the SOFP? 8,000 plus 2,000. And finally, received in advance. Okay. So I take income as 10,000. Cash received will take more. Received excess. This is called income received in advance or income pre-received. This is a liability. Because that 5,000 is an excess amount which is not belongs to you. Right. Double entry, cash account debit. Then rent income account credit. 15,000. This is rent received in advance. Double entry is income account credit debit, advance account credit. Since advance is a liability, we have to credit that. balance the rent income account.
Right. Uh, Give me a minute, guys.
Recording in progress.
Okay. So if you prepare for the income statement, it's 10,000. For statement of financial position, we have a rent received in advance and the current liabilities. 5,000. Okay, so complete this. Tomorrow we can discuss some past paper questions related to preparation of financial statements. Any questions? Is it clear? The stock, debtors, and accruals. Okay, so you can complete this. Tomorrow we'll discuss the past papers. Okay, right.